Hello everyone and welcome back to Tradeaverse. My name is Shane and today we're going to talk about two very important things. The first thing is when is the best time to buy, and the second thing is how is the best way to buy, and these are both very important. I want to start this video off with an example. Let's take a look at the year 2022 coming all the way down to 2023. In this year, you guys can very clearly see, even though there was multiple fluctuations in price, that the trend was actually downwards, as opposed to the year of 2024, where we are at now, where prices actually shot pretty much straight up with only a very small pullback that lasted a short amount of time. Now, this is where we're going to get into our two questions. When is the best time to buy? Because if you were to ask most people, the best time to buy is when things are on a discount. So buy it as price is cheap. But what happens if you buy and then you buy again, but it just keeps going down, as opposed to maybe over here, you didn't buy, you're waiting for the discount, and instead it went straight up, and now you're stuck buying way up here, as opposed to the original entry you could have got for the new year because we didn't break downwards. So these are the two things that we're going to pretty much talk about in this video, and 110% when you guys leave this, you're going to know exactly what to do. Now, the really cool thing about this is we're actually going to use no indicators, and we're going to start by taking a look at a previous effect that used to happen in the market called the January effect. Now, what is the January effect? This used to be a trading strategy that is not really strong in edge anymore as the markets kind of become more efficient, but essentially the way you guys can think of this is in the previous years in the stock market, when you would come into December, most companies would actually start selling their assets. The reason for this could be taxes, it could be rebalancing, or just simply they're in a lot of profit and they're just getting ready for the new year and want to start clean. Now, typically, December, you would then see a lot of selling pressure as all these people are letting go of their assets. And then in January, you would get the January effect, which means most people have sold off. Now they're looking to rebuy for the new year. So normally at the start of January, they would start picking their picks, and obviously the prices of stocks would start pumping because everyone starts buying. Now over time, the edge of this has become a little bit more flat. There is a little bit of an edge that's still left, but for the most part, it's become relatively flat and not as effective. But one thing that did stay is if you do see January close higher than its opening price, this is a very strong indication of what the market is going to do for the rest of the year. And I actually have a strategy where I'm going to show you guys this put into effect. Now we're going to start with the S&P, and we're actually going to zoom out here and go to the monthly time frame just so you guys can see pretty much the entire history. We're going to go back from 1871 all the way up to where we are now at 2024. Now, what are the rules for this strategy? What we're going to do, and this is going to tell you when to buy. If January closes its month at a higher price than where it opened at, this is your time to buy. So let's go ahead and actually take a look at the results here. So let's turn on our January effect, and we're going to make sure that we have our first long condition on, which again will only buy if January closes higher than the previous years. And this is the results you guys can see right now. So does this strategy actually outperform buy and hold? No. But the purpose of this is not to outperform buy and hold, but take a look at the win rate. The win rate of this strategy, when you buy after the month of January is closed, higher than the opening price of the new year, there's an 86% chance that you are going to realize a return on your investment. So if January actually closes the month out green, as you guys can see here, you do not need to worry about scaling down. You're going to be focusing on buying as much as you can, whether it's DCA, whether it's buying on dips, but pick up as much as you can, even if price is building upwards, and get ready to close that off at the end of the year. Okay? Now, if we take a look at this in reverse, let's say you actually went and bought when January closed lower than the open. So let's say the S&P's price is $10,000 when the new year started, and now coming to the end of January it's closed at $9,000. So it's actually closed lower than the new year. If we go ahead and take a look at these results, then what you would see is your win rate is actually only 57%. Right? So now it's essentially a coin toss on whether you're going to be profitable or not. And if you guys actually take a look at your net profits, it goes down to 175% as opposed to our original 5,578%. So right there, if January closes green, then you're looking at buying for the rest of the year. You're expecting high returns. If January closes red, you're expecting low returns, and this is not really going to be a good time to buy. Now, it is still true that buying things at a discount is one of the most profitable ways of investing. And up until this point, there's pretty much no investment strategy that has beaten buying at value, which is buying at a discount. There's only one fund in the world so far publicly, which is the Medallion Fund, that is able to actually use day trading or quantified trading to actually outperform buying at a discount. Other than that, you have some of the tops like Warren Buffett that does value investing, buying at discounts, and these guys are incredibly profitable year over year. So how do we buy at a discount then? Well, for me, it's actually very simple. What I would do, and let's go ahead back down to the daily time frame, and let's go take a look at 2022, where we had this massive red year. Now, what I like to do is I use a martingale approach, but I use a martingale approach where we have no stop loss. So this is only going to work if you're doing value investing. So maybe you're buying this year in hopes of selling it within the next 2 to 5 years for a pretty decent return. Now, I'm going to actually show you guys how I go about buying as price is building downwards. And I'm also going to show this on Bitcoin. The reason for that is I want to show that this is my all-time favorite strategy, buying when we are expecting to have a negative year. You can even use this on very volatile assets. That's specifically why I chose Bitcoin. It is an asset that can pump and dump 70 to 80% on a very, very rough year. You can see all of the returns that it made get absolutely squashed. Look at the drawdown on this, up to 78% on that drawdown. But I can show you how to get so close to the bottom. You'll be within 5 to 10% away from the actual bottom, and then obviously realize massive returns from that coming into the next year. Now, in order to do this, let's just pretend that Bitcoin in the cycle actually shot all the way up to 100,000. The reason I'm just saying this is to make the math easy. So let's say the all-time high was somewhere around $100,000. What I would do is first we look for our condition. So our condition is for January to close out red. So let's take a look at the year 2022. So we come into 2022, here's the open of January, and as you guys can see, if we get to the end of January, which is going to be the 31st, you can see that the first month closed out red. Remember, this is our indication that we are not looking to buy. We are not looking for aggressive moves to the upside. If anything, we're looking for more bearish activity for the rest of the year. So now what we're going to do, knowing that the rest of the year is going to be red, is we're going to slowly scale down our position sizes, but they're going to get bigger and bigger and bigger every time that price drops. So what we'll do is we're going to go from 100K, and we're going to run 100K down pretty much as far as you want. But typically what I do is I find the worst drop that your asset has ever done, whether it's the S&P, Bitcoin, Tesla, I don't care. Find the worst year it's ever done and create that as your box. So for Bitcoin, I know that it can drop 80% in 1 year. So again, let's pretend that Bitcoin went all the way up to 100K that year, and then the new year started. Now, an 80% correction would actually bring us down to about $20,000 flat. So what we're going to do is every time Bitcoin drops $10,000, or in this case 10% from the average entry, we are going to go ahead and start scaling in order. So our first order is going to be, let's say, 1 Bitcoin. Our second order then would be 2 Bitcoin, then it would be 4, then it would be 8, then it would be 16. So we're pretty much going to apply a martingale, but we're not going to use a stop loss. Now, if we actually go and take a look at this in the calculator, here you guys can see the Bitcoin purchase price. We're going to start buying at 100K. We're going to buy more at 90, buy more at 80, 70, 60, 50. Let's go all the way down to that $20,000 correction that we are looking for. And again, every time we drop $10,000, we're just going to double our investment amount. So we buy 1 Bitcoin, then 2, then 4, then 8, then 16, then 32, 64, 128, and then finally 256. Now watch what happens to our average entry price. When I click calculate, you will see that our average entry price is now sitting at 29,823. If we were to mark that off on our box, our average entry would be somewhere right around here, which is pretty much dang near the bottom, right? If we were to go from 100K down to 20K, if this is the bottom, you're sitting right here. That's pretty much the low, right? And if we were to apply even just us being in at an average entry of 20,000 and then selling it 1 to 2 years later, you would see that our return from that would have been 151%, right? Now, if we were to actually repeat what Bitcoin did here in its entirety and actually ran all the way back up to 100K to retest its all-time highs like it did in this scenario, then our return obviously would be much higher. It'd be sitting somewhere around 259%. The best part I like about the strategy as well is it normally leaves you a little bit of money on the side. So if you're doing something like the S&P is not going to see an 80% correction. I mean, on a bad year, you might see a 40% correction. So in that case, if you're scaling down every time we drop 10%, you're going to only have about, I mean, maximum 15 to 20% of your account in, but it's going to be in at a very, very good average entry price, which is going to give you maximum returns for, not much of your account invested. You're going to still have 80% of your account on the side that you can choose to do whatever you want with, right? If you want to buy bonds, if you want to put it in a high interest savings account for the year, if you just want to keep it on the side because everything's red's a little bit scary and you just want to have that extra bundle there in case you want to do a big buy or whatever your reason is going to be. This is why I love doing this strategy so much. So essentially, this is how we'd buy as price builds to the downside. Now, we just talked about a lot right there, so let's do a quick recap. When is the right time to buy? The right time to buy statistically, especially for the S&P and Bitcoin, is going to be when the January of the new year closes green. That is the best time for you to buy with as much as you want, whether it's all of your account, half of your account, 10% of your account, whatever it is. That statistically is the best time to buy here on the S&P. It has an 86% win rate based on the last 36 years. It does very, very well. Only 14% of the time you will see red. Okay? Now, when is the best time to start DCAing, or how is the best way to buy? The best way to buy in a downwards market is to do the martingale scaling approach that I talked about, where we're going to start with a small amount of our account balance and scale it up more and more and more as price builds to the downside. Again, I suggest, just me personally, what I do is I allocate only 20 to 40% of my portfolio to allow me to do this, to let me keep a lot of extra money on hand in case I want to do a big dip buy or whatever it's going to be, right? But now, what do we do if price starts breaking to the upside? So let's say we had January come, it closed green, we bought in with as much as possible, but then it comes around to like August, July, September, and we have all this money that we made from working all year, or maybe we made it from dividends, or maybe an inheritance, or hey, maybe you won the lottery and now you want to put this money in. What do you do there? Now, there's two very easy suggestions that are free and pretty much you can do at your own discretion. The first thing is obviously just dip buy. Every time you guys see a decent correction on the way up, it could be a 10, 15, 20% correction, 5% correction, whatever it is, you can obviously sprinkle in more on these dips as price builds upwards. The other thing is you can just do nothing. All the extra money that you keep, you can have it on hand. And the reason for that is even though you win 86% of the time with this setup, take a look at this max drawdown of minus 62%. This means that 1 year, and the year of this was the pandemic, there was a market crash of 62%. Did the year still close out green? Yes, but there was a correction of 62% to the downside. So if you bought all in on January, and let's say the correction came around August, all that extra money you made all year, you could have used to buy on this massive dip opportunity, which would have scaled you into exponential profits at the end of the year. So me personally, I would just keep the money on hand, let it sit, and if you do see a big anomaly like that, which does happen pretty often, you get major corrections, even in these upwards trending markets, then you could start looking at scaling in there, right? So those are my two suggestions. Now, for those of you that want to help support the channel and support me, you can take this to another level. So we have a quant-based strategy, which is actually really simple, and you're only invested for pretty much 7 days of the month, which is pretty awesome. And you do this every single month, you're invested for 7 days. And with this strategy here, you guys will actually be able, let's drop down to the daily, to outperform even buy and hold. So this is our quant-based strategy where, again, you're invested 7 days of the month, and you guys can unlock this by pretty much doing what you would expect. We have a website, go join the website. You can go ahead and purchase this, sign up for our mentorship, and you'd obviously gain access to this tool as well. So you guys could develop your own quant strategies that you could use, that you could scale in on the rest of the year, or you could use our quant strategy, which is pretty decent. It has a 63% win rate, maximum drawdown of 28%. This is including the COVID crash, guys, 28% with an average gain on your trade of being about 0.6%. So this is a really awesome and effective setup that you guys can use as well. So I'm going to wrap the video off there, but quickly before we go again, don't forget to check out our website if you guys want to gain access to the strategy. And we also have a free Discord that you guys can join. So you can join, you can post your profits, you can go ahead and do some analysis with us. For developers, you can post your own tools and source code for people to use. We also do a lot of work in Python, and I'm constantly posting some interesting stuff, talking about betting strategies, different compounding strategies that you guys can use. And we're pretty much always talking about the markets, whether it's crypto, Forex, or stocks. So thank you all very much for watching, and until next time, we'll see you later. Peace.